Hey everyone, welcome back to Corporate Decoder, the place where we dissect the companies you invest in. And today we're going to pull back the curtain on Iris Acquisition Corp IES latest SE filing. Get ready, because this one's a wild ride with a lot of jargon that we'll simplify for you. So, what's the big story here? Iris Acquisition Corp II, a special purpose acquisition company or SPAC, is gearing up for its initial public offering. We're talking about raising a cool $150 million by selling units that consist of shares and warrants. But what does that really mean for investors and what are the hidden risks? Let's dive in. And hey, before we get too deep, if you love getting these kinds of straightforward, no-nonsense breakdowns of financial documents, do us a favor and hit that subscribe button. Also, we've got a burgeoning community on Discord discussing these filings, so join us there using the link in the description. Alright, let's decode this filing from Iris Acquisition Corp II. This is essentially their IPO prospectus, meaning they are going public. They filed this with the Securities and Exchange Commission, or the SEC, way back on the 12th of December, 2025. This company, Iris Acquisition Corp II, is a blank check company, often called a SPAC. Think of them as a shell company with a pile of cash created specifically to buy or merge with another already existing company. That is their initial business combination. They haven't picked that company yet, which is a big point we'll get back to. Now for the juicy part, the offering itself, they're offering 15 million units at $10 per unit. Each unit is like a bundle containing one Class A ordinary share and half of a warrant. Warrants are like options that give the holder the right to buy more shares later, at a set price. In this case, $11.5 per S-share. The idea is to raise money for that future acquisition. Here is where things get interesting with SPACs. They have a sponsor, Iris Acquisition Holdings, the LLC, who gets founder shares at a super low price. It is common practice, but it means the sponsor can make a lot of money even if public shareholders don't do so well. The filing details how the sponsor, and even the underwriters, are buying these private placement units at the same $10 price, but this is separate from the public offering. Then there is the founder shares, bought for mere pennies. They explain how these founder shares convert into regular shares, often at a ratio that can dilute regular shareholders, a critical point for any potential investor to understand. Let's talk about the people running the show. Sumit Mehta, the CEO, has a solid background in investment banking and M&A, especially in the Middle East. Lisha Palmer, the CFO, also brings extensive financial experience, and a number of directors with impressive backgrounds will oversee things. They've all been involved with Iris Acquisition Corp, a similar SPAC that merged with Lemonatus Pharma. This suggests experience, which is good, but also raises questions about potential conflicts of interest, especially when they also have stakes in the sponsor. Now, we must always look at the risks. These are really important. There are a lot of them, as expected with any IPO, but especially with a SPAC that has no operating history. They say things like, our public shareholders may not be afforded an opportunity to vote on our proposed business combination. Basically, you might not get a say in what they buy. And then there is this point about redemption rights. Public shareholders can usually get their money back if they don't like the deal. This could mean a lot of money leaves the company, making it hard to do a deal if too many people redeem. This is a crucial strategic risk. They haven't picked a target, remember. This means you are investing blind. You can't assess the risks or potential rewards of the actual business they'll end up buying. It is a huge gamble, and they are very upfront about it. Let's scroll to the capitalization table. This shows how the company's money structure looks after the offering. Right after the offering, the total capitalization is projected to be over $150 million. This includes the money from the public offering and the private placements. A key figure here is the Class A ordinary shares, subject to redemption, which is a whopping $150 million. This highlights how much of the company's capital is essentially earmarked for potential redemptions by public shareholders, not for investing in the business itself. And then we hit the dilution section. This is where we see how much the original owner's stake might shrink the value for new investors. Look at these numbers. For example, if there are no redemptions and the over-allotment option is not exercised, the dilution to public shareholders is almost 30%. That means for every dollar you invest, almost 30 cents is immediately eaten up by the value of the founder shares and other pre-IPO arrangements. If there are maximum redemptions, the dilution to public shareholders goes up to nearly 100%. This is a common SPAC issue, but these numbers show it's particularly stark here. The initial investment by the sponsor of just $25,000 for founder shares versus the $10 per S-share public offering price is the heart of this dilution. Now, let's look at the auditor's report. This is critical for understanding the company's financial health. This is a big red flag, substantial doubt about the company's ability to continue as a going concern. The auditors are basically saying they're not sure if the company will be around in the long run without raising more money. They even mention the lack of cash and working capital deficits, while they detail plans to raise capital. Like the IPO itself and sponsor loans, this statement from the auditors is a significant warning. Looking at the statements of operations from the 8th of July to the 30th of September 2025, they report a net loss of over $50,000. This is typical for an IPO stage company as they haven't started operations yet. It is all expenses and no revenue. The key takeaway is that their real financial performance will only begin after they buy another company. The notes to the financial statements give us critical context, for example. Note 1 explains their entire business model is based on finding and acquiring another company within 24 months. If they fail, the money returns to shareholders. Note 4 highlights the related party loans from the sponsor, totaling nearly $48,000 as of September. These are common but always worth tracking. Let's move on to the underwriting section. This tells us how much the banks are getting paid. They are raising $150 million for the base offering, and the underwriters are taking a $9 million cut. That's a 6% fee. Plus, there is a deferred commission of $6 million paid only if the deal closes. That's a substantial amount of money going to the banks. Finally, let's quickly touch on the securities themselves. They issue units, Class A ordinary shares, and warrants. The structure of these units is important. 1 share and half a warrant. This is a bit different from typical SPACs and affects how much dilution you might see. The founder shares, which convert into Class A shares, can cause significant dilution to public shareholders because they were acquired at such a low price. So, what is the final verdict on Iris Acquisition Corp II? They are following the SPAC playbook, raise a bunch of money, promise to find a great company, and hope for the best. The risks are clear, no target identified, reliance on the sponsor. Potential for dilution, and even the auditors' doubt about their ability to continue as a going concern. However, they have an experienced management team, which is a positive. The dilution numbers are quite striking, especially the almost 100% dilution in a maximum redemption scenario. This means if many shareholders redeem, the initial investments of the sponsor and early investors become even more dominant in the company's capital structure. Ultimately, investing in this SPAC is a bet on their management team's ability to find and successfully merge with a high-quality company in a competitive market, all within a tight deadline. While navigating significant structural dilution, it's a high-risk, potentially high-reward play, but informed by these numbers and risks. Alright, that is our deep dive into Iris Acquisition, Corp II's IPO filing. What is your take on SPACs and this particular offering? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button, it really helps us out, and of course subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.